Okay, Gabe, do you want to share the PowerPoint, Gabe? Thank you.
You're on mute, I think, Gabe.
All right. Thank you for joining our webinar and how to drive powerful decisions from your data. My name is Kim Anselmo, and I'm going to help facilitate our event today. We can go to the next slide, Gabe. That'd be great. Because before we get started, I do want to go through a few Zoom platform tips so you can engage with our presenters and have the best experience possible. So you should see the following icons on your Zoom toolbar: ask a question, chat, and raise your hand. If you do need any assistance, you can click on the raise your hand button. I will connect with you as soon as possible. We do encourage you to please ask any questions through that Q&A or that chat button throughout this time, and we will answer them as soon as we can. If we don't get to that question today, we will be sure to connect with you personally afterwards as well. Next slide, Gabe. Thanks. If you do experience any audio issues, you can access your audio settings and test your audio when you are already in this meeting. At the bottom left corner of the Zoom meeting toolbar, you'll find either the headphone or microphone logo to join audio or mute and unmute, respectively. Click join audio to choose to connect your computer audio and dial into the meeting with a phone if you need to. Or once your audio is connected, click mute to disable audio or unmute to enable your audio. And with that, let's get into our learning objectives for today. So we want to help and go over the importance of the FP&A for data for SaaS, CFOs, and financial teams. We're also going to review examples of dashboards and KPIs critical for your success, and go over which metrics are relevant to your size, growth rate, and business model. And with that, I want to hand it over to today's presenters. We have Gabe Masis and Mike Bergenis.
Thanks, Kim. Hi, everyone. My name is Gabe Masis. I'm a manager here at Armanino within our consulting practice, and I currently reside in Columbus, Ohio. Spent my first half of my career at Ernst & Young within their audit practice, and then jumped ship over to the consulting world here at Armanino within our FP&A technology consulting group with a focus on Workday's adaptive planning. So here at Armanino, we have a wealth of industry experts, and I'm pleased to pass it along to one of our technology industry experts, Mike.
Good morning, everybody. My name is Mike Bergenis. I am the Senior Director of our Strategic Finance Outsourcing Group. We're a group of CFOs, controllers, and senior analysts that focus on FP&A and other Office of the CFO services for mid-sized companies. Before I came to Armanino, I was the CFO of a $40 million ARR SaaS business where we implemented Adaptive. So looking forward to sharing some insights and some war stories with you. Okay, so why don't we start with our first polling question? We're going to have a few of these during the half hour just to help us tailor what we're doing here. Just trying to start off with something basic. What's your current level of ARR, as we mentioned before? How big you are and how fast you're growing really in a lot of ways dictates what metrics you're looking at or what's more important. Okay.
Great, Mike. We'll give it just a few more moments to let everybody answer.
Okay, so this is a nice distribution.
Awesome. So if anybody else wants to answer, get yours in the next moment here. We're going to close it up.
So as this winds down, I just wanted to point out that this is a nice distribution of company sizes. You know, typically when you're a younger or a smaller company, our sales-based metrics are probably what you're focused on most. Others, as you get bigger, you've got CLV, what's your lifetime value of a customer, and you're trying to hone down your business model. So we'll talk about both types.
Great. And I just went ahead and shared those results, Mike.
Great. So I would say, obviously, the vast majority are under 100 million, but a nice breakdown of the different groups. So we'll try to speak to everybody here as we go along. Thanks for sharing. The first thing I wanted to do is talk about why are metrics so important. You know, everybody talks about SaaS metrics. Well, The important thing to keep in mind is the reason SaaS metrics are so important is because the financial model is unique. And GAAP, which is great for financial statements, definitely has its drawbacks when you're trying to assess the health of your SaaS business. Why is that? It's because sales and marketing spend is upfront and revenue is delayed. It's an annuity. You're not getting immediate benefit from that sales and marketing expense. And the goal is to make that money back over time, right? But GAAP is one of the major cornerstones of GAAP is matching. We're trying to match expenses with revenue. We're matching those costs. And really, that's very difficult to do with a SaaS company because SaaS spending really starts out with acquiring the customer. So sales and marketing is OpEx. It's not cost of goods. So it's really easy to match your cost of goods with your revenue in most companies, but not when a small company is getting started or a medium-sized company is growing rapidly. So the bottom line is often a SaaS P&L looks bleak. Like, look at all that expense. We're losing money hand over fist. But that may be that might mean it's bleak or it may not. And that depends totally on what your metrics are saying. Right. So the goal here is losing money is great or bad, depending on the metrics. Losing money with good metrics could mean ultimate success. As a matter of fact, if your metrics are good, SaaS veterans and people who know the business will say, spend more, because that reward will come later. The more you spend, if your metrics are good, the more you'll lose, which can be a little bit stressful, but you're going to have a better result in the end. If you're losing money with bad metrics, you're in trouble, and you need to dive in and fix your business and fix your business model so those metrics can turn around. So if you can't imagine running your business without financial statements, if you're a SaaS business, you shouldn't try to imagine running your business without metrics. Okay. So very quickly, how do SaaS metrics get used? If you want to grow, everybody speaks the metrics. Investors, bankers, vendors, potential acquirers. They expect you to be fluent, and they understand that you might have your own take on certain metrics, but you have to make those clear. And your vocabulary in this language will change over time. Okay? Your size, your growth rate, even your business model will all dictate not only what metrics are important, but what ratios are in the sweet spot, in the kill zone, so to speak, and which ones you need to tweak. So, but calculating the metrics is not enough in and of itself. You've got to define, as we said, understand and benchmark those metrics. You have to be accurate. You have to have the right context. You have to know how to manage them. What actions should you take? And we'll talk a little bit about that later. And your management team has to be fluent. They have to be able to converse together in this language. CLV is an example, customer lifetime value. There are so many different ways from so many different perspectives to affect that, whether it's pricing, whether it is packaging, whether it is how the contracts are written. Everything affects CLV. Okay. And so just a quick, before we dive into the benchmarking and the other factors related to metrics, just want to give a real quick 101 lesson here. So I always call customer lifetime value and customer acquisition costs the meta metrics, right? It's basically this is the top of the pyramid. How much does it cost to acquire a customer, and what is the customer worth over time? But why those are meta metrics is if you break them down, there are a lot of individual metrics under those that are important to understand. And these are the levers that will move your metrics into the kill zone. Sales efficiency, the whole idea of time is money. Sales efficiency is how are your teams hitting their quotas if they're direct salespeople? How long is it taking? What is your conversion ratio through the funnel? Sales funnel. On the customer lifetime value, what's your contract structure? What's your expansion level once you sell to customers? And are customers churning? If so, at what rate, right? As we mentioned before, if your metrics are good, burning cash is just fine, but you want to be watchful of that. Obviously, cash is king. SaaS is a cash upfront business. So it's really important to do this modeling, the forecasting, have vigilance as a finance team to make sure, even though some of your controls on the dashboard might be scary to a generic type of business, the other metrics are telling you everything is fine. Okay. And the other thing is there are a million SaaS metrics under the sun. So it's really important for you to understand which ones are most important to your business and for you to be able to move them and manage them for progress. Okay. So if you could use some help, we are within our technology group here at Armanino. SaaS is our biggest subgroup. And we have developed some small diagnostic programs for people where they can get value immediately and take action immediately. The first one that we did was SaaS metrics evaluation. And we're happy to talk to anybody about that if you want to dive into this topic in more. And with that, I will hand it over to, we're going to do another poll question. All right.
Absolutely.
Kim?
Yep, just launched it.
All right.
We'll be fairly quick with this one.
All right, we got a lot of you answering. I'll keep it open just for a little bit more. And closing it down right now in 3, 2, 1.
So now we're sharing the results. So this makes a lot of sense. Obviously, if you're growing your smaller business, sales and pipeline related is really important. Churn also, which is a very important part of measuring customer lifetime value, is an important one. What's interesting is cost of customer acquisition. This is one that we have found that people are quickly realizing is becoming a more important part of their business. A year and a half ago, investors and businesses were focused on sales at all costs, or grow. Now, with money tightening in the capital markets and people wanting to make their money last but still wanting to grow, how much it costs to acquire a customer and how to manage that number down and still be effective is becoming more and more important. Okay.
Awesome.
So with that, I'll hand it back over to Gabe.
Yeah, so let's talk Workday's adaptive planning and SaaS metrics. So before we get into the tool itself, I wanted to give a quick background. So Armanino partners with Workday to implement their enterprise planning and reporting cloud solution called Adaptive Planning. As one of the leading solutions in the FP&A space, Adaptive is way more than just a visualization tool that we're going to show you today. But I'm excited to show you how we can use the dashboarding functionality in Adaptive to understand key SaaS metrics. So it's important to note that data can be integrated from your ERP, your CRM, your payroll system, or really any system into Adaptive. One thing about the dashboards in Adaptive Planning as well is that they're user-friendly and easy to manage. So in most cases, C-suite or executive level personnel are not the ones using the tool on a day-to-day basis, as they probably rely on their FP&A team to own the tool. But something cool is if a C-suite executive logs in, the dashboard screen can be the first thing that they see, and that way they can analyze the results right there without any intricacies of knowing the tool. All right, so what I'm going to do, I'm going to stop my share here and switch to Adaptive. All right, so for purposes of this demonstration, the data portrayed in these graphs is mainly related to forecasted data for fiscal year 23. So we look here in our first perspective. Mike earlier pointed out that sometimes data can be misleading, right? So I'm going to start off by showing you a chart that will show an overall revenue and margin summary here, right? You can see here that you have your high level revenue and margin statistics, but we need to dive deeper into the SaaS metrics to determine if we are actually trending where we want to be as a company. So next, take the pipeline, so which was the majority of what the crowd here voted as how they track their metrics. If you look at the first graph, it represents the number of qualified sales opportunities as part of the overall marketing leads for that month. So you can see on the right side, we have conversion percentage for each quarter, with Q2 being the highest conversion percentage. But to give you perspective, although Q2 is the highest, we can see in our leads over in this graph is that we actually had the lowest number of leads in Q2 for the year. Okay.
Right.
So when we and the power of adaptive is you can actually drill into some of that data at a more granular level. So for instance, in this graph, bar graph here, it's the same data as up here in this graph. If I drill into April, because I want to understand April's data, I'm going to drill into an account level view. Well, now I can see in April of all of my marketing type of leads, what was going on there, right? So we can see in webinar, there were 0 leads because maybe there was no webinar, right? So again, probably basic level of data, but just trying to show you the power of the drill through option and be able to discover what the driving force of a key metric is in adaptive. So I'm gonna go back here. Next, I'm going to talk about, and Mike alluded to it earlier, is the funnel. So we can see this gives a nice view of, okay, what were my leads? What were my sales opportunities? And then what were my new customers, right? So you can see the funnel, and there's 2 different ways in adaptive. This is called a pyramid. This is called a funnel, right? You can see data in a graphical way, right? That shows you right there without having to dig too much deeper. It shows you right here in a graphical representation. The other cool feature here, presentation mode. So I can actually, if instead of avoiding all those PowerPoints, I can actually put my different graphs in a PowerPoint type of presentation within this actual tool itself.
So as a CFO, I'm looking at this and I'm saying, first of all, not only is this giving me an idea of how efficient my funnel is, it can also tell me how fast things are moving. So this is the first step to really understanding if you're going to have issues with cost to acquire a customer. The other one is speed. How quickly does this happen? Not only is that important to me for efficiency, but it also helps me understand how I should forecast bookings and revenue from a delayed effect if I'm bringing in leads and moving them through the funnel.
Awesome. So next, I'm going to pop over to the next tab here, ARR. I'm going to get out of presentation mode. So we can see here in this graph here, we have a new versus upsell versus churn scenario. So in your blue line here, you can see that this is all your new ARR. In your green, you can see that this is any upsell that's happened through the year, and your purple is your churn. So we can see churn fluctuate quite a bit. But the important read here is that your ARR is continuing to grow. The other 2 graphs here, and specifically this line graph over here, it's going to show you your new ARR percent year-over-year growth compared to your ending ARR percent year-over-year growth. So you can see they're both growing at a steady pace. The blue line, which is your new ARR year-over growth, is steeper than your green because we see on this graph, right? You're losing more churn than in your upsell.
Yeah, so this really highlights what Gabe has here, really highlights the need to dive deeper and segment what you're looking at. This is something Adaptive does really, really well. So on the left, that's a tale of 2 stories, right? If you're just looking at ARR growth, you're thinking, oh, things are great, right? Because the net of the blue, green, and purple is up. But what it's really telling you is, hey, you're losing ARR from your existing customers. If churn is more than upsell, then that might be something you need to look at, because if new bookings drop and it exposes rocks at the bottom of the lake, you're going to want to have had a plan in place.
Thanks, Mike. All right, let's take a look at our next tab here of our cost of acquiring customer, our CAC, one of our favorite lingos here in the SaaS world. So you can see here these three charts. It's going to represent your sales and marketing expense, your new customers or new logos, and then an average CAC per month, right? So you can see the build of, because your sales and marketing expense, your new customers is going to build up to your CAC, right? You can see the data here live. So really fully quantified CAC rates help companies, manage their growth and accurately engage the value of their acquisition process. Then we have the bottom here, we have our sales and marketing as a percentage of revenue. So really we can see the total percentage of revenue, and then within the sales and marketing, we can see what's sales and then what's marketing of that full number.
Yeah, I would just call out two things here. One is those of you who are not selling to large enterprise customers, $659,000 to acquire a customer probably sounds crazy. And everything, like all stats, it's all about the context, right? So what the customer lifetime value is compared to that is super important. We'll talk about that in a minute. The other one here is that really works across sizes of companies is thinking of sales and marketing as a percentage of revenue. The good news is there's so much data out there that there is even ways to tell if you're a $5 million company growing at 60% a year, what the percentage of revenue dedicated to sales and marketing should be, or what that range is of your peers. And this works at all levels. That's the benefit of so many people focusing on SaaS metrics, is there's so much information out there.
Thanks, Mike. All right, let's talk about our last section here. So our customer lifetime value. We have two charts represented here. It's really CLV shows what your average customer is worth. Maybe for those still in that startup phase, as Mike was mentioning, it can be a key indicator of your company's value to your investors. So you can see here we have our CLV to CAC ratio, and Mike's going to dive in a little more about what the ideal CLV to CAC ratio is.
Yeah, I mean, as you look at this, yes, $665,000 to acquire a customer is a lot, but as you can see, while the lifetime value for the first 3 quarters shows that it's below that, which obviously isn't sustainable over the long run. You can't pay for more for a customer than a customer's worth. You see it poking up and headed north at the 992,000. So obviously those two are important to look at. It's fairly common to look at a CLV to CAC ratio of about 3 to be your goal at least in the interim. If you achieve more than that, more power to you. But it's also very difficult, at least when you're first getting started, to really understand what the CLV value is. You don't necessarily have information on how readily people expand with you, or after the initial sale, or you don't understand necessarily with a lot of data how churn might affect that. But those are two key factors in calculating CLV. But for more mature companies or ones that have really found their product market fit, 3 is a great goal to set. If you're below that, don't worry. It's more important that you're moving in the right direction.
Thanks, Mike. So we're gonna pop over and back over to our PowerPoint. All right. So we're gonna have a third and final polling question here.
And so we covered a lot of information in these first these 30 minutes. This was a speed round webinar. just wanted to know if people are interested in learning more about FP&A, tools like adaptive and metrics. Okay, so we'll let that run. And while we're doing that, why don't we try to address some of the questions that came in while we were presenting. One of the questions that we had was, what metrics have changed with the current banking system issues? I would say the metrics haven't changed. The importance of certain metrics, and I alluded to this earlier, are coming out. And that is one of the reasons why the banking system and Silicon Valley Bank specifically ran into trouble was there had been for many, many months, lots of money coming in from venture capitalists. Raising money was a lot easier. What's happened over the last 18 months is raising money has been more difficult. People have been drawing down their balances, and their liquidity was compromised in some way, in part based on that. So the message there is, and I mentioned this earlier, understand your cost of acquiring your customer. If you're not being asked by your board, if you're not being asked by anybody who would raise money, you would raise money with, if you haven't in the past, you will now. It's super important to stretch your runway, make sure you're efficient there, and give yourself a chance to raise money in a more benign environment, I guess would be the word I would use. Is there a way to capture the time delay of CAC now that results in CLTV 2 to 3 quarters from now? I'm not sure I understand the question there. The time delay of CAC. I'm going to have to come back to that one, or maybe somebody could type a clarifying statement in. But I would say that they're really kind of independent of each other. And the reason why there is the time delay between CAC and CLTV is why it's so important to manage with metrics, because all the money gets spent up front to acquire the customer. The question is, if you don't have a good feel for what that average customer is going to bring you in value, you don't know whether you're spending too much. Okay. Maybe this is one you could help with, Gabe. Do you have any recommendations for FP&A tools other than adaptive?
Yes, I think this question specifically mentions around being adaptive, being too robust and expensive for small to medium SaaS companies. And most of the time, they do not have a dedicated FP&A staff member or team to be able to implement and manage such a robust system. So I will say adaptive, there's a wide range of customers from small to large enterprises. For our smaller enterprises, typically it's a let's walk approach, right? Maybe you're not full into the system, but if you're going to grow, it's something that I recommend is, hey, we're not fully there yet, but it's good to get in now as you begin to grow, begin to add on to your models. It can be a walk, jog, run, sprint approach, right? Oftentimes you do with clients of smaller sizes.
Yeah, I think that's important. And our teams can help you evaluate whether adaptive is right for you, or you want to start a little bit lower and grow into it. What I will say is that our team, the strategic finance outsourcing team, has adaptive experts who can train and can even drive for you on a fractional basis if you need that. So you never have to worry about having somebody who can use the tool or train a new person at your company to be able to use the tool. And I'll just end with this last comment. How would you calculate CLV? CLV is really as simple and as complex, depending on how you want to calculate it, as saying, what's your contract size, right? Are you getting cash up front? Think about the initial sale. And then it's as simple as saying, hey, there's a certain percentage of those that are going to go up in value. That's the expansion part of it over time. And there's going to be a certain number of them who downsell or churn. So you need to have that data to be able to extrapolate out what the distribution of value is. We'd be happy to talk to anybody about how to calculate CLV for your company.
All right, so I believe that concludes our webinar. If you had questions in the chat, we will try and hopefully we'll have your contact information and we'll be able to get back to your questions via email.
Great. Gabe and Mike, thank you so much for your information. And we will be reaching out if we didn't get to your questions, as you mentioned. Also, you will receive a copy of this recording and the presentation as well. Thank you.